Good morning, ladies and gentlemen. Well, while we know that next week is going to be dominated by the war headlines between Iran and Israel, it's important to know that also we have the FOMC and three other central banks, which are not unimportant. What is the central bank going to do? I think after the CPI and PPI figures that we had this week, it's most likely that they're going to keep the dot plots absolutely where they are, which basically means that every time the 2-year note goes up to 405, it's a buy, because they just will not stop speculating that we are going to have two or more cuts this year and then another two cuts next year. There is an outside possibility that for 2026 we go to three cuts, which would be bullish for the short end, but in any case, conflicts are steepeners. So I very much doubt that we can go through this 405 level, 404, 405, and if we do, I think we're going to come straight back. So the 2-year note, more likely than not, can even rally a little bit if we have a dovish presser. Powell is always comes out as dovish, even if he's not. So the 2-year note is the one that I'm really not worried about. I would be worried about anything out 10s to 30s because, as I said, wars are inflationary, and let's have a look at those and some of the spreads. The one that is slightly puzzling is the fives, but I think that the reason why the fives are trading so well is because people want to have some duration on, but not too much. And also they expect that the Fed will be dovish and therefore fives are going to be just okay. I would avoid the fives as well at the moment because they seem to be in the center of a butterfly. And the way to see that is if you look at something like 530s, you can see that over the course of the week, it didn't steepen, right? It just didn't. But something like 2s, 5s, flattened a tiny little bit. I mean, 1-2 basis points. It's nothing to write home about. But you can see that the 2s and the 5s are absolutely stuck together and have been for a best part of 3 weeks now. They haven't gone anywhere. So I would avoid the 5s. I would stick to 2s and something like 2s, 10s. I think it's very, very unlikely that we can break the 42 level. And in 2s, 30s, I think it's very, very unlikely that we can break, higher than this. And this level seems to be 89. So those are the levels I would much rather still be invested or trade long the 2s than anything else. And if you look at the way the curves, the technicals look, here we have the 200-day moving average right there, and it's capping it. In the 10s, here we have the 200-day moving average, and it's from below and it's rising. And in the 30s, even more so. So it just tells you that the natural thing that the market wants to do, especially in a headline-driven war situation, is to steepen. Even though you get some carry at the long end, and this is the 10s, it just can't go or stay below the general collateral level, which is, tends to be 433. That's where the funds are. Every time it gets to 433, people take profits because they don't see how 10s are going to give them any profit. Where, unless you think Fed funds are immediately going to drop, which the likelihood of that is next to nothing. I think the first possibility of the Fed funds dropping, unless something big happens in the economy and unemployment just isn't going up fast enough, is going to be sometime in September. And if we don't get it in September, then it's then we're only going to get one cut this year. So I really don't see the point of buying tens below 433. You're going to have to fund them for months and months at zero or negative, and what is the point of that? So to me, the curve steepener is still the natural way. Every time the tens get to 433, it's rejected. And just look at the technicals. It's just not conducive to owning duration. Exactly the same thing is going on in Germany and in Europe in general. The Bund just can't break the 200-day moving average, which is now turning positive. If you look at the French market, that is even more perfect. Every time it gets to the 200-day moving average, it gets, the futures get sold higher in yield. If you look at the Italian, that's the only one that has a descending 200-day moving average, and that is why I prefer to own Italy over Germany, simply because it has more pickup. So the funding is better, and that's all that can be said. I think the Schatz is now dead for a long, long time, and really it's in a big trading range from around 190 to 193, and on panics you might get it down to 171, but that is a 20-25 basis point trading range that we're going to be in for the whole of the summer. There's no way that the ECB will cut, and really the one market which is more affected by the price of oil should be Europe. Maybe not the price as so much as the availability of oil. So the one that should have more worries should be Europe, but that should be more reflected in equities, European equities, rather than in the yield curve or any bond market. So I wouldn't really be worried by Europe, but here we are. We have, I just hate the Bund. I think it's going to go 290, and I think it's going to go 365 at some stage. It's the, dog days of summer. The ECB's on hold, so the only way that the Bund can go much higher is if the yield curve steepens. Because, as I said, you're going to get absolutely no movement in the Schatz. And is the yield curve steepening? No. There was actually some flight to safety, as it were, into Europe, and 210s actually flattened a little bit. I think if you see 53, 54, but I don't see how you're going to see it, that will be a great level to get into the steepener. By that stage, the 200-day moving average should have caught up as well. I see no reason for the yield curves anywhere to do anything but steepen, and anything else that happens seems to be short-term trades, and the market moves 3-5 basis points, but that's about it. I'm just looking for levels to put on steepeners, and if I want to be long of any bond market, I go into the 2s and 5s, and if I want to be short at any stage, I go into the 10s and 30s. Really as simple as that. Even war headlines and the inevitable higher demand for dollars that's going to come about from a higher oil price couldn't help the dollar to go higher. So what you have to say is that we are in a trend that is going to see the dollar trade at the very least 96.47, and that is my, let's say, 1 month target, and then lower towards these 90s, very low 90s, where it tends to actually trade sideways. So translating that to the euro, you see that this has been my target for a long time, and we are sitting on it. But as you can see, we're opening up the weeklies, and let's enlarge that weekly chart. It seems to me that every time we break this 115.40 level, we haven't really broken it yet, but it looks like we can. We go to at least these high 118s to 119s, and that is where really the battle takes place around 120. So it seems to be destined for up there for these kinds of levels, high 118s. Not much else that can be said about it. Going back to DXY, I think next week I would be surprised to see it break 98.81 to the upside. I think that is going to be very, very good resistance now. So those are the levels that I like to trade when it gets, a headline squeezes it. But I think 98.81, you buy more put spreads on the Dixie, or you buy more call spreads on Euro USD. I think it's as simple as that the administration still wants a lower dollar. The lower dollar helps it achieve its trade aims and trade deficit aims, and the market is going to be more than happy to oblige them at every opportunity it gets. Been saying for weeks that GSG was too cheap, and here we go. It's going up for the wrong reason, though, because war is a one-off event. I don't like the fact that he hasn't consolidated, but there you have it. I still think that GSG is cheap, and I think that any dip down into the 22s is going to be very well supported and bought. I don't think that we see one of these moves. I think that we see, I really don't think that it's going to go below 22 again. Or if it does, it's going to be by pennies. And eventually it breaks up. So if you're not worried about these 2-3% that you might lose, it's still a decent time to own GSG, because the technicals are finally opening up, and this period of, 3 years just about worth of consolidation, certainly 2, is over to an extent, and the prices are going to go up. And that is another reason why I just can't see any value in long duration bonds. So there you have it, and it's still traditionally cheap against gold. This is gold GSG, right? So have a look at where we are. We are really still at levels that last we were in 2020, and this is a very long term. So from 2010, gold is going up in terms of GSG, but we are at very, very inflated levels. If I was a producer of commodities, I would be pretty annoyed that I'm not keeping up better with inflation, that gold is so much outperforming. And when you think about it, if this is the norm, this is 450 and this is 13. So gold has returned 3 times as much as commodities in the past over a decade. Is that realistic? Can that remain like that forever? I don't think it can. I think GSG is still a better buy than gold. So gold didn't make a new high, but it closed right at the previous high close. And as I've just told you, I think commodities are a better buy. I think it would have, had it wanted to go, it could have gone. It could have been much more impulsive, but it wasn't. I think people are beginning to recognize what I've been saying for a long time, that gold is expensive in terms of commodities. And if you want to hedge, commodities are a better hedge than gold here. I think that we continue screwing everyone. It goes up to 3,500, it comes back down to 3,350, it goes up, it goes down. What it won't do for the time being is make a decisive break below 3,350, but at some stage I just see it trading around while commodities consolidate and then move higher. To me, gold has probably done too much, or everything is going to do for in the short term, and really it's the turn of commodities. Bitcoin seems to be tracking equities rather than anything else, and it's a risk on asset. That's what it seems to be at the moment, which to me says that the least likely rather thing that it's going to do is make new highs if it continues to behave like equities. I think that it's more likely to stop everyone out below these lows and stop a whole load of people out below the 200-day moving average and do something like this, just stop them out. The real important level is this one here. If all we're doing is remaining in a big trading range, that is bullish for the rest of the year, after the summer into the days when equities can rally. I don't think next week is the week that equities can do anything at all to the upside, because they're not going to get much help. They're not going to get much help from the Fed. The Fed is going to be absolutely neutral. And if the Fed is absolutely neutral, why would equities start rallying on the back of that? I don't think that we're going to have any positive headlines from the war, and therefore, equities at best are going to be in a range. And if that's all I can see for equities, then probably that's all I can see for Bitcoin. And as long as it keeps on closing below 106,235, I just see no reason why it wouldn't make a quick break for it, stop everyone out, and then maybe from 92,000 go again. To me, in US equities, nothing has changed. I still don't see it breaking the 60-40, which is the high monthly close, and it keeps on failing up there. I really cannot see it breaking up next week, because I don't think, as I said, anything is going to help it. So what is the very short-term technical situation? You can only look at the very short-term technical situation. I think the likelihood of it breaking up into this range, 6,003 to 6,090, is minute. Just no headline is going to help it. Certainly not from the Fed. So the only possibility I see is a quick move down to 58.65, and that to me is going to be key. If we ever close below 58.65, that opens up quite a bit of downside, and certainly down to 56.69. But I don't think it's going to happen next week. Well, I mean, it always could, but I really don't see why trade them from the long side. I think the likelihood of it breaking up is almost zero, and therefore it has to test these levels. If it tests 58.65 and breaks it, then you have your answer. But the overall message here is that unless it starts breaking up through the monthlies, the high monthly, and trading up there consistently, I just think that we are very, very stuck. And that is really where the NQ is. You see, NQ is trading better, right, than ES. Therefore, it broke the high monthly. But even the monthlies are coming in. And you can see what it did last time that the monthly Bollingers came in. It did one of those. It basically went down for 3 months on the trot. And that shouldn't really surprise that it goes back towards the 20,300 level. It really shouldn't surprise that it does that over the course of 3 months, because it's really struggling to maintain this upward momentum at the moment, and I really don't see why it should. It'll probably trade better than ES, but that's not much consolation. To me, the level here, 20,400, call it, is going to be critical on the weeklies. And really, only short term, if it starts trading below 20,660, can you see it being weak. Everything else is gap filling and, trading around. But the thing that I think it's least likely to do is bust upwards, because I just don't see any catalyst for that anytime soon. And even if Powell is in some way dovish, and you know, he might come out dovish, but the dot plots will not have changed. There will be no help from facts as opposed to, sort of the way people interpret some word he pronounced. So I just don't see the rallies being sustained in either NQ or ES. And I think it's much more likely that we come and test downside levels, the first one of which is here at 21,100-ish. I've been telling you to watch EEM, and it did exactly what I thought it would do, 47.93, and backed off. This is significant to me because I think it's an indicator that it wants to go higher, but it can't now. And I think it's going to do one of these. It's going to come back to 45.04, and then it's going to go again. I think it's very, very unlikely that over the course of the next 2 or 3 weeks, we don't touch 45.04 and get some energy for higher prices later on towards the end of the year. I think the fact that we have done this formation, shot our bolt, says that all equity markets are unlikely to test the upside very much over the course of the next couple of weeks. There will always be a bull market in something, but when even the sectors which should be outperforming on the headlines are not really impulsive, that tells you that the rest of the market should be even less bid. This is ETA, and if you think of anything that should be trading higher on the back of wars, this is it, or XAR. And it's not. It's just consolidating. I mean, it's definitely in an uptrend, there's no question about that. But over the course of the week, it was actually down on the week. And if you have a look at XAR, that was down on the week as, tiny. But it's not up, and that's the point. The point is that what is taking the strain is the spread. The spread is always taking the strain. So it's SPY that's going up less or down more than those sectors. And when those sectors themselves can make no new highs, that tells you that the impulsion in SPY should be next to zero, and the likelihood is of lower prices rather than higher. So overall, I expect absolutely nothing from the Fed. I expect them to keep the dot plots exactly as they were, and therefore the market, certainly at the short end, to do absolutely nothing. And if we see the 2-year anywhere around the 406 area, you definitely want to buy it, because the odds are that it'll rally back down towards the 390s at some stage. But in any case, even if you bought the 2-year at 406 and you don't like it, you can always sell some 10s or 30s or even 5s, and at some stage you will make money, because the yield curve is going to steepen. I just see no alternative to that in the longer term. Otherwise, I think equities next week have a bit of a tougher week than they had last week, for all the reasons that I mentioned. And really the way to play it is to play the downside until we get to 58.65. Being short at 58.65 is not good, because you could get a 100 tick rally very, very quickly off that level. But playing down to that level really makes a lot of sense to me, and I'll be doing that in the week ahead. Everything else I don't like. I think GSG, if you want to invest, GSG dips are still a buy. I don't care what the Iranian conflict ends and it goes down 5%. I fully expect that to happen at some stage. But I think that people will be surprised that GSG at some stage starts a very strong bull run of at least 10 to 20%. Thank you very much indeed, and tweet you on Monday.